very happy to be here in London. Frederick asked me and repeated me several times that I should be very short. So that's good because you don't want to hear a long speech about continental Europe. Let me just make some advertisements about our publications first. You have, I think, in your booklet something that we do every quarter which is called Panorama. It's a nice French Latin word for our publications. We have three subjects that we deal. One is country risk, the second one is insolvencies, and the third one is sectors. The one you have is on insolvencies. Not most of them, we translate them, of course, in English, except when the subject is really very Franco-French. But this one was translated in Austria. Don't ask me why. So so maybe it may hurt a bit your love of the nice English language. So the next one, which will be on country risk, and the issue will be a very important one, which is Italy. It was translated by a British translator, so we are going to be safe with translation. So about Europe, I heard a lot of what David was talking about. There was a lot of course, echoes of what we are living across the channel. Of course, the austerity issue is the same, and there was like yesterday or the day before some release about the performance in terms of fiscal revenues of the French government. And as it is, of course, with the recession going on, we have heard that a lot of the taxes that was expected was of course much lower than expected. And this is the problem that we see now, is that the austerity that is being implemented. I'm not sure we can say that austerity, by the way, is implemented in France, because it's more like the idea that we are on the wrong side of the Laffer curve. You know what I mean? We have so much taxes now that no one pays them anymore. So, but anyway, in other more serious countries, they actually do a lot of austerity, and of course it's hurting very, very much their growth. And the issue that we have, it was also raised by David, is the fact that it hurts growth, but it also doesn't help the sovereign, because of course with the fact that the fiscal revenues are decreasing, in fact public debt in the Eurozone are still increasing. And by the way, we're looking at the UK numbers, we have much larger debt in the Eurozone. We are at I think an average at 100%, I mean 90-something% of GDP. In France, we are close to, we are between 90 and 100, and that's really, I mean, very large debt, and they are still increasing, despite the fact that most of the countries now do some efforts. So it's hurting growth, it's hurting the sovereign in a way. So it's not efficient, and there's a huge debate about that, of course triggered by the IMF itself, who said that we should maybe do a little less severe austerity these days. And I think it's going the focus of this year is that most of the countries now are kind of, you know, negotiating, whether they are in the Troika package or whether they are not, they are kind of negotiating less austerity. But it still means that in 2013 you can't expect spendings, net spendings of the government to help growth in 2013. So it will be a little less severe than before, much, by the way, less severe than in the US. If you look at the pace of reduction of the public spending in the US, it's much stronger. Of course, it's not something that they really want because it's because of their political system, but it's going faster than in Eurozone. So government, forget it, sorry. What about consumers? Well, of course, that's the problem. And the problem is that, contrary to the British ones, the consumers are very rich, most of them in Europe, especially, forget also the Spanish one, is that we have a lot of money, but these days we don't spend. And you know, when you look at the household net wealth, I mean, you look at Italian, for example, or Belgium, I mean, we have a lot of savings and a lot of money. We could spend, but we won't spend. And the reason why we won't spend is, of course, two issues. The first one is the labor market, which is deteriorating really very, very fast. And you can see here the numbers. I mean, the UK seems really heaven compared to what's happening in the Eurozone, compare what's happening in Italy, for example. People talk a lot about Spain and about the level of employment in Spain or in Greece, which is really scary. But in Italy, for example, it's increasing very quickly. In France, too, it's deteriorating. So that's one, of course, of the reason. And the second one being, I think, something a little more institutional, which of course, do not touch you very closely, in a way, which is the way the Eurozone institutions are dealing with the crisis. I think we had a lot of optimism after the summer with the OMT of Mr. Draghi and all the promises said about saving the Eurozone. And I agree that the Eurozone, in a way, is saved. We are not going to see a collapse of the Eurozone. But it doesn't mean that we're not going to see another sovereign crisis within the Eurozone. And this is something that we tend to forget because the spreads are so low. But there is still a danger on Italy or on France that there is a problem on the sovereign side. We are very dependent on market confidence, and it can be a political shock or an external shock that really, I mean, makes this confidence that we have now with very, very low spreads, for example, in France, just collapse. And this is something, and the way we handle this kind of systemic crisis in the Eurozone is still not optimal, to talk about an understatement. And look what happened with Cyprus. The way the crisis was handled was absolutely awful, because when this happened, of course, there was a lot of contradictory statement, which is not good when you want to deal with a confidence crisis. And of course, ultimately what's happening is that the country is saved. That's what happened with Spain, with Portugal, with Ireland, and that's what's going to be happening with Cyprus. But all these discussions, these contradictions, it seems that we still don't have the tools. I don't even talk about, raising competitiveness in Europe, which are long-term questions. No, I just talk about simple, clear firewalls. We don't have them yet. And the fact that we don't have them yet, I'm come back to this, is that people are still afraid. People are still afraid, are still holding on their cash, if they have. And this is why you won't see the spendings, we will see spendings decreasing in most of the countries. Now the big question is exports. And I was very struck when I heard David that he didn't speak more about this issue, because we are obsessed in continental Europe with the issue of exports. And we are obsessed by one word that I didn't hear, which is competitiveness. Of course, in France especially, because we have lost a lot of market share in the recent history, and you see that. And one of the big issue about exports saving the Eurozone right now is that it's not doing badly. It's true in some countries. You see it in Spain, you see it in Italy. It's beginning you see it in France, although not so great. But the problem is twofold. The first one, on the very short term, is that we are still very integrated with each other, meaning the more you have recession and contraction in the Eurozone core, the more it touches the other countries. And you've seen the first quarter numbers of Germany, which were so bad, and were mostly so bad because of the recession in France and the recession in Italy. So now really there is a contamination with when a country is really good in terms of a structural and specialization in export, like Germany, is now touched just through the magical transmission channel of integration, of trade integration in the Eurozone. And you see that we are all losing market shares. You see that slide. But of course, when you look at the German performances, it's not that bad. I mean, it's still holding very strongly at a very high level compared to what's happening, of course, in France, in Italy. So there are really two different worlds. And this is what my point is that we have one of the big issues we have in continental Europe is to fix a crisis with very different countries, and what these differences are increasing over the time. And we want all to export to Brazil, to Russia, to China, but the weight, the impact of such an engine is relatively slow, except for Germany. You see the dynamic of German exports again to the BRICS, but when you look at Italy or France, it's less than 2% of GDP. It's very small. So it's great to export in China these days, but it won't be enough to be the engine against what's happening on the domestic side, which is really dramatic. So competitiveness is the issue. We are all looking at it. And here again, there is a lot of differences. You see the unit labor cost. I mean, all economists in continental Europe have this chart, so this is not something very original, because we are all looking at it. So that's how much costs one unit of one value added of what you produce. And what you see in this chart is, of course, the German story that everybody knows and everybody repeats very masochistically in France, is that, oh my God, they've done so much effort in terms of keeping their costs, and you see that they've only increased by 10% when they've increased by 35% over since 2000 in Germany versus Italy. So clearly, I mean, they've done a lot of efforts in keeping their costs in line. But the other thing that you see is, of course, that there has been a shift. You see that it has been decreasing very heavily in Spain, in Portugal, even more in Ireland, where you see that here there has been an effort through the devaluation. And if you look at what's behind, it's of course a little real wages, but most of it is it's through quantitative, meaning that it's people shedding out of work. It's unemployment rising. So you do the same kinds of things with less people. Of course, it costs you less. And this is, of course, this adjustment on the unit cost of labor is very violent because it has an effect on the domestic side because these people are, of course, unemployed. And what the other things that you see, that this adjustment, you don't see it yet in Italy or in France. The unit cost of labor are still increasing. So we are not yet gaining price competitiveness. And this is one issue that and now French are not only looking at German that are taking market share that's lost, but they are looking at now Spain that has apparently taking market share to French, and obviously because of that. And there is not only this issue, of course, there is the issue of quality competitiveness. So there are lots of ways to look at it. If I look at the number of patents by 1,000 inhabitants, so, and you look that also you have huge differences. I mean, you have really Germany being so much ahead, and France is not doing so bad, but in the average of the Eurozone, and really the more Southern Europe doing very, very bad. And this problem of the ability to really increase the value added of your export is really the key problem, the key long-term problem for lifting growth and for lifting exports in Eurozone. And so yeah, the transition we expect that David was mentioning from consumer-oriented economies to export investments economy is going to be awfully painful. And you see it here. I mean, you see the history of growth in those since 2002 in Europe, and you see it. I like this chart because these are the contribution to growth, to GDP growth of each of exports, of consumption, of households, and of government. So you see at the Spanish story, you see that here. I mean, they've partied a bit too much. 1.2% in terms of consumption. That's really too much. I mean, this is the bubble. This is the problem now that they have. And it's not only a housing bubble, it's a debt bubble, it's a private debt bubble. So they really have to get rid of this debt. And of course, it is very painful. And you also see that in terms of public spendings, they have been quite dynamic. But here, I must say that because they had a huge growth, their public debt has decreased very much. So yes, they've done a little spendings, but they could afford it thanks to the growth. But when, of course, when you look at their net exports results, I mean, of course, they have been terrible, and they've entered the crisis with a huge current account deficit. If you look at Italy, let's we speak with France, and when you speak about France, yes, it's of course French is it's between Italy and Spain, meaning that we are a very, very consumer-oriented economy. We are not partying so much, meaning that we don't have so much debt as far as households are concerned, but we are a very, very oriented, consumer-oriented economy, and with a very historically resilient consumption in France. That's something amazing. Even in 2009, on the whole year, consumption was positive. But you see that we like spendings, we like public spendings. Okay, that's not a scoop. I mean, you see that also it helped a lot the economy, and that's all. And I think the two are linked. I mean, if you are in an economy where you, in a way, feel protected, you spend. And this is the issue in France. Now, if we are going to do austerity, not only is it going to hurt the direct effect on net public spending, but it's going to hurt consumption not, because the consumers will not feel that protected. So the transition will be very costly in France. I don't say I mean, we have to do it. This is not sustainable, of course. But the way we are going is going to be painful. Now, Italy is like France, but a little less, dynamic. I mean, yeah, the same model, but with less dynamic consumption, because the labor market is very fragile. And of course, you have the inverse mirror of all the Southern Europe, which is Germany, with not consuming very much, the households, very, very rigorous on their public spendings. This is why they don't understand why these Southern Europeans, they don't believe in austerity. We believe in austerity because we've done it and it's worked very well. Yes, but because one of the key issues is that it works because you get all your growth from outside. So what's your inside anyway doesn't help you a lot. But when you have all your growth from your external markets, austerity doesn't hurt so much your growth. So it's very different. The effect of austerity in Germany or in France will be very different. And of course, great on net exports, of course, has been a positive drag, of course. So when you have debates on Europe about the exchange rate, it becomes very difficult because the Germans, I mean, I was in Mainz, they are very happy about the level of euro. I mean, oh, please, we want to keep this euro. It's so great. I mean, and when you talk with French exporters, like we should have an exchange rate devaluation. We can't do it anymore. So yeah, we can't have one monetary exchange rate policy for such heterogeneity, and this heterogeneity is even more painful now that we have recessions. So yes, there is an issue here, and this is why I'm not as optimistic as the majority of you apparently on the UK. I think that we're going to have, yes, maybe we can get out of the recession at the end of the year, but we'll have a very, very low growth. And that's going to be the problem of Europe. So anyway, for our short-term forecast, this is the brand new one, which is going to give you the boost for this afternoon, minus 0.6 for the Eurozone. So we 3 months ago, we believed that the recession would be less severe. Now we believe that the recession would be more severe. Of course, we integrated the Q1 numbers, which were pretty awful for France and pretty awful for Germany too. The biggest revision was on Germany, in fact. I was a very German optimistic. I still believe that Germany will not go into recession, but it's true that simply because, as I said, they are integrated in the Eurozone, their exports are decreasing very much, and they hurt clearly. But consumption, in a way, was resilient in Germany, and that helped a lot. That's going, I think, to help a lot the growth, and they have a lot of strength. We revised downward Italy. I'll come back to that. Spain is the same story. It doesn't change so much. We revised upward UK. That hurts when you're French, but sometimes you have to do it. And the numbers are there, so can't fight. Japan also, we of course upgraded it, and US exactly like Robin, but I think we can have a debate about the US economy after. So, facing this environment, how do corporates behave? Now, you look at this is very impossible to read this chart. This is the debt, the corporate debt on GDP, and this is the margins they have. And you see, you have some cases that are very interesting of what's happening now. The first case being Spain. So when you look at Spain, you see that they have a very large, rather large level of debt, meaning that, of course, you know that the corporates and the households in Spain are very leveraged. So, of course, now they are in the process of cutting their debt, exactly like in the UK. This deleveraging process is happening in Spain. But you see that they've restored their margins very much, because of what I showed before, which is the decrease of the costs. They have now very, very nice margins. The thing is that now we are in the process now of a little healthier corporates in Spain, which is a good news because it had been a bad bloodbath in Spain, clearly in terms of failures of corporate bankruptcies. Now they are stronger, but of course they are keeping their cash. And the reason why they are keeping their cash is that they have a huge debt to service in the next years to the banks. So they are not going to invest that much. And this is why we are not in a growth situation, but we are at least in a situation where clearly the average health of the corporates in Spain is better. When you look at Germany, of course, it's the heaven, low debt, high margins. So I don't want to talk about them. But you understand why, even if there is a downturn in the economy in Germany, the German corporates are strong enough to face this downturn. And this is the big strength of course, an economy, even like the US also. The US corporates are very strong. So even if the economy is not doing very well, they can now, they have the financial health to resist, to be resilient, as the word was used by Robin. And finally, France. You see that France has a problem, has a big problem of margins. And that's the issue, because we have those smaller, medium-sized corporates that are very, very fragile in France. We have those very large corporates that are very solid. They are mostly all investing abroad and investing in emerging markets, while those small, domestic-oriented corporates are extremely, extremely fragile these days. I will also come back to that. And another very interesting indicator is the way you would react to what's happening on the credit market. So it's the cash flow to investment ratio. Are you able to finance yourself, your investments? And here also you have, of course, very different cases. Again, Germany, very strong. Okay, forget it. They are they are not very dependent on the credit, but what we see historically in Germany is that they have these local banks that are very helpful when there is a credit crunch coming from the commercial banks. So, I mean, they win on every side. And you look at Spanish corporates, which of course, they increase their margins, so they increase their independence towards the credit market, and that's good because, as you know, the banks are really cleaning their balance sheets now in Spain, so they are cutting the lines. So it means that, of course, you have a very huge credit crunch, the biggest in Europe these days in Spain. And in France, you again have a lot of corporates which are very dependent on the credit market. And by the way, as you know, in continental Europe, in most of the countries, we have a different system than in UK. We are mostly much more dependent on the credit market than on the financial market. Most of the external financing goes through banks, so especially in France. So, but it's happening, the fact that in France, the credit market is one of the most resilient so far compared to other, I would say. And Italy also has now a big problem on this issue, but I will come back to that. So German versus France. Well, how to tell you that? Of course, as I said, we have here the rate of bankruptcies in Germany and France, meaning the number of bankruptcies on the total number of corporates. You see what's happening. You see that since a lot of time now, the German level is half the level of France. So it has to do with, of course, the macroeconomy. Most of the German corporates are very sensitive to the exports, of course. And then, since the exports have been doing very well since 2009, they are strong. And of course, they are financially very healthy. And you have this structure in Germany, which is very different from France, when you have these large Mittelstand, you know, these medium-sized corporates, which are very strong, family-oriented, very well capitalized, and very resilient. And when I was in Mainz, you could see them talking and being so optimistic about the world. Well, when you talk with French medium-sized corporates, they are really suffering. So you have clearly a different world here. Now, what's happening in France is, as I said, scary. We have a special review on French bankruptcies. In terms of number, it's kind of stable. It's like 60,000 bankruptcies, while it was something like 40,000, 45,000 before the crisis. So it's still stuck at a quite high number. But the problem is that you have a size effect in France, is that when you look at the cost of bankruptcy, meaning the debt to supplier of the failed corporate, you have a number, 4.34 billion euro, which is almost the same as 2009. And this is because more and more bigger corporates fail. And you see it in the press almost every day in France, that they have, in the agro-food sector, in the retail sector, those rather large players who are simply disappearing. And this is something that's scary, because also it, of course, has an impact on, it has, of course, an impact on the labor market, it has an impact on the confidence. So it also fuels, in a way, the ongoing recession in France, which we point, by the way. We are very much under the consensus at minus 0.4. So your big partner is a bit suffering now. But thank God there is Italians, because they are worse than us. I mean... but that's not that funny, of course. I mean, the claims, when you look at our, so we are going to issue a special report on Italy. And the paradox, the strong paradox with these economies, that contrary to UK or France, it has huge strong points. It's a huge industrial economy. It has more, it has like something like 20,000 exporting corporates, while there are 15,000 in France. So there is a dynamism of the corporates in Italy, which is amazing, but their macroeconomic performances and their micro performances are not that great these days. You see in terms of claims, we are so 100 both in 2007, and you see that there is something happening in mid 2011, where clearly here the deterioration of the claims ratio in Italy is much worse. If you look at the claims ratio, I mean, compared, because if we just look at the dynamic, you have to realize that in terms of claim ratio, traditionally, the claim ratio in Italy is 3 times what we know in France. Since the crisis, it's 7 times more. So you clearly have a problem with Italy. And the point of the paper was to say, why there is such a difference? First, is this difference explained by the growth differential? Because it's true that the growth numbers are worse in Italy than in France. So can you match the growth difference with the claims difference? No, you can't. Even if you had the same level of growth in Italy, you would still have more claims. So there is something else in Italy. So this something else is, I think, 3. The first one is banks. I was not only in Mainz, I was also in Milano, and there was a banker talking to in the same country's conference, and he was very clear. He said, credit has been too generous in Italy. Now the banks have to clean their balance sheets, so we are cutting the lines. So it's the first time I hear a banker actually saying that, because, I mean, to hear a French banker saying that, it's impossible. And you see, of course, that. I mean, you see the non-performing loans increasing amazingly in Italy. So the banks really have an issue here, and they are very severe. So that explains, of course, the recent period, but that doesn't explain the long-term history, because, of course, before, I mean, I would say the last year, credit was rather generous in Italy. Other explanations, the structure effects. You have much more very small corporates in Italy. When you look at the structural effect, the number of very small corporates in the total number in Italy, it's the biggest in the Eurozone with Greece, and very, very far even from France. So here you have a lot of very small, tiny actors that are extremely fragile. And when you look at the dynamic of the margin, maybe you looked at Italy, it's not that bad, but it has decreased very much. And in terms of the dynamic of margin can play also a very big role. And thirdly, there is another problem in Italy that we also know in France, but at a lower scale, which is delay of payments from the public side. There is huge delay of payments from the public, from the local authorities, from the central government, which of course triggers business-to-business delays. And by the way, the Italian government is really trying to do something. He announced that they will pay 2013-2014 half of these delays, which is roughly 55% of GDP. The whole is 10% of GDP, so that's a lot. So again, Italy is really a difficult case. So if you look at our assessments, so we are measuring here not the sovereign risk. We are not downgrading UK like other agencies. No, we are looking at the corporate risk. And so we look at the A1 countries, Japan with a negative watch, but I think now thanks to Mr. Abe's Japan is back, we are going to lift this negative watch. Was Switzerland, Canada, okay. The stable are Germany and Australia. We have downgraded Belgium, France, Netherlands, along with UK. Why is UK is A3? Well, it seems to perform a little better in terms of growth these days than France. We've had a lot of claims in UK before during the crisis. So, and that's not exactly, surprising, since one of the difference between the UK and France is that the UK corporates are very highly leveraged. So their fragility towards the credit crunch or towards the recession is much stronger. So this is why it was much more, but now France is the same as the UK risk. And to me, I think it's more or less the same, since the fact that now dynamic of risk in France is rather deteriorating, while it seems that the dynamic of the UK is rather stabilizing. But to tell you the truth, when I looked at the quarterly growth number of the chart of David, I mean, I thought it was very scary, in fact, because you look that there is a very volatile growth in the UK now. So the party is not completely won, by the way. And then the B countries are Spain, Italy, Portugal, where we suffered a lot, and Greece, of course, in C. So I look at Frederic, he seems to smile, so it means I have some time for the BRICS. Not so much, no, okay. Not so much time. So just a word about emerging markets. We are fairly optimistic, but clearly, I mean, of course, I mean, compared to the area I've just described, it's the heaven. But nevertheless, something is happening in the BRICS. Clearly, I mean, we have downgraded almost all the growth outlook of the BRICS. Russia has had a terrible first quarter. Brazil has had a very disappointing first quarter. China, of course, as you know, it has been a bit disappointing. Although the numbers are okay, they are in line with what's more or less we expected, but they are also a bit disappointing. And India also has had the last quarter was also the last quarter of the fiscal year, because in India they've not the same year. It was not that great. So something is happening in the BRICS, and what's happening now, I think, is that those long-term issues that were more or less hidden behind the carpet are now becoming short-term problems. You name it, infrastructure in Brazil. You have now a problem of infrastructure that is really impacting growth. Governance in Russia, clearly. I mean, you see now that people and Russians do not invest in their countries. There is a lot of capital flights, and it's beginning to hurt your growth. Again, the first quarter was terrible. and China. So I will end with that. What is the problem with China, I think? It's leverage. I think there is a big issue now within the Chinese economy of leverage. And you look at the Fitch rating estimates of some of the debt numbers, which is very, very difficult to assess, of course, and those numbers have to be tackled. But you look at the yellow, and you look at the private debt. The first number is the official credit number, the stock, which is already one of the highest in the world. In Eurozone, the credit is something like 100% of GDP. Here you are at 136% of GDP. But you have to add some estimates of the shadow banking, which is all the way the corporates do finance themselves out of the banking system, out of the official banking system, which has been growing very much. And this is the most dangerous issue these days. You happen with a very, very large leveraged private sector. So is that a problem? It's not the same as Spain, because Spain has, as I said, was dependent on its external creditors. So this is why the leverage in Spain is an issue much more systemic than in China, which of course is not dependent on external creditors. It's mostly domestic debt. And what's happening now is that when there is a problem, in fact, the Chinese government through the banks refinance the debt. But it's a more micro issue, I think, because you have a tendency of a slowdown, which is happening now in China, meaning that some of largely leveraged players will be hurt because of the slowdown, because there is no place for everybody, because there are lots of overcapacities in China. Some of your partners may be hurt. And the problem being that this leverage is not transparent. You don't know exactly what's the size of the leverage of a corporate or a public entity that you deal with. So I think this is the big issue now for people trading with China. And I think I'm ending here because I think I was longer than the time I was assigned to. Thank you.